In this video, we will discuss about terminal value. Terminal value is also known as continuing value. If you remember DDM, initially dividend of first year discounted by cost of equity, then we move to dividend of second year discount by cost of equity raised to 2 and so on until dividend of nth year where dividend is divided by 1 plus r to the power n. As per our prior discussion, calculating dividend beyond a certain point becomes a challenge. So at that point in time, because of the information constraints, we apply that the growth in dividend will be constant after that year. Let's say post-year 9 dividend growth rate is constant. The same logic is applied on free cash flow too. We usually have a multi-stage scenario. Let's say that for 5 years, the earning would be 15%, and then for next 3 years it will be 10%, and post that it is 3%. The terminal value formula can be applied only at a stage when we have a constant growth rate. We apply terminal value beyond a certain point, as we do not have any visibility of the data points beyond that. Before that year, we will look at company's information. We will look at the management discussion and analysis section. These all are available in annual reports, commonly known as 10K reports. The management discussion and analysis, sometimes called MD&A, this section in the annual report talks about what management expects in next year or next few years, what are their growth plans, what are their challenges, and so on. So, basically management's point of view that where the company is going. This is a very important section as it will give direction to us that how the company's performance is expected to be in next few years, at least next few years which are in near term. To realistically check all this information, we need to perform industry as well as country level analysis. This basically says that once we have a proper understanding of the company and understand what are the drivers, and when we analyze more at the industry and country level, it will validate whatever management is saying, if those statements are feasible or not. As an example, let us that there is a possibility a company is planning to set up a power plant somewhere and industry is also supportive that there is a good demand for power plant. But let's say there is some economic change and there's an economic decision taken by the government that power sector will not stay with private sector, or there is a withdrawal of subsidies, or any other change in policy which can impact a company's operation into power sector. So this kind of information we need to tie it together to understand the overall story of a company, whether it can deliver what they are promising to deliver, and what are the other challenges or strengths. In nutshell, we are doing a SWOT analysis. We need to identify strengths of the company. We need to understand weaknesses of the company or challenges. We need to understand opportunities of the companies, and the last is threat. With experience, we become more comfortable with this kind of analysis and even start predicting a lot of results with the company. After a few initial years, we need to apply a formula in order to calculate a terminal value. This is the way how the overall thing will work. But terminal value will be applied at the end when dividends are growing at a constant rate. Let's say dividend in 9th year is $100 million and the growth rate is 5%. Cost of equity 10%. So, 100 by 1 plus growth rate, which is 5% divided by 10% minus 5%, and we got 21. This is the terminal value. This is the present value of all the future dividends after nth year at nth year. We have applied Gordon growth model. The similar process can be applied to free cash flow to the firm where the cash flow will be paid to both debt holder and the equity holder. Free cash flow to the firm would include 2 elements, one dividend and another interest. Interest is paid to the debt holders and dividend is paid to equity holders. In this case, the free cash flow to the firm will be discounted by weighted average cost of capital. Weighted average cost of capital is the cost of capital for both debt and equity. In case of dividends, we took only cost of equity as dividends solely belong to the equity holder. That's all for now. See you in the next video.